Hi everyone, I'm in my hometown, London. Got a great view here and London's its own economic island and things are pretty good here. This is a brand new building that a major client has now moved into, and I've just taken the opportunity to give you a view from the 16th floor, which is quite high for a London floor. Over there you can see the post office tower, and back there is the Shard, which I think is the tallest building in Europe now. You can probably see the London Eye back there. Okay, so interesting times. We're approaching $70 oil, said the man that called for less than 50. But of course, we're still in September, and the call was that we're going to have to take a look at where we get to by February of next year. And a lot of that is going to depend on things like winter. But at the moment, definitely oil is behaving much better than we anticipated. There's no question about that. One of the simple things is, if you recall on one of these videos around the time of the initial tariff announcements, I said it'd be 100% likely that the US would go into a recession, which would be 2 quarters of negative GDP growth. And that simply hasn't really happened because the tariffs haven't really happened. And in fact, we had a Washington expert on one of our calls the other day who was saying that there is actually no signed trade deal with anybody. There is no text of any deal or anything else. It's just a whole load of uncertainty. And so what's happened is the economy has sort of kept stumbling along without the tariffs really seeming to have a huge impact in the way that we thought they would. Because arguably they were never fully applied, basically. I mean, there were all these exemptions and everything else that, for example, remember the war on Canada, stuff like that, that just kind of disappeared into the ether. So anyway, basically things are going better economically than you might have anticipated. And that hasn't been the biggest issue, actually, at the margin of oil being towards 70. The biggest and most tough one has been China building inventory, which has been at a clip of about 1 million barrels a day. And the mood has now turned towards the idea that China is going to keep building inventory. Now, of course, if oil prices get too high, that becomes a cap because the Chinese presumably will stop building. But the fact that they're buying at, $60 to $65 Brent was really interesting insofar as clearly they think oil prices will be higher in the future, which would be partly related to the risk that they have in being heavily import dependent. China imports 11 plus million barrels a day of oil, of which 20 to 30% comes from sanctioned countries. And as a result, they need to build inventory. And one of the fascinating things here about how you can be wrong in oil was that at the beginning of summer, people said Chinese inventory was 60 to 70% full. Now summer is over, and people say that China's been building inventory somewhere between 500,000 to 1 million barrels a day. And inventory is now 50% full. So it seems like they built some inventory capacity. And the view is that, generally speaking, for numerous reasons, China will continue to build. And at the current rate of build, that would leave them buying potentially 500,000 to 1 million barrels a day of oil for another year, right through to the end of 2026, assuming prices don't go too high. So that's been a major change at the margin, because in a good year, the entirety of global oil demand growth is 1 million barrels a day. And from nowhere, we got China building 1 million barrels a day of inventory. So that was definitely a run over moment for the bears. The one that's more controversial is Russia and the Ukrainian attacks on Russia, which are primarily on refining. But there's also, for example, overnight, you see some video of a waterborne drone, a motorboat drone attacking oil export ports. There's a lot of issues out there that are visible in pricing in the market. So, for example, you've seen strong Dubai oil prices relative to Brent, which indicates that India is moving back towards buying Middle Eastern oil as opposed to Russian, and that there's generally some demand strength in Asia, particularly China, at the margin, that's causing all the, for example, increased Saudi availability of oil to get sucked up into the market without any great need for discounting. So that's also been bullish. Now, again, you're in a situation where you're relying on inventory build, but equally, China has no track record of selling the inventory. They build the inventory and they hold it. It's a security of supply measure. And as a result, that's simply oil that's off the market, which is beneficial to prices. So those have been three aspects: strong economy, China inventory build, and Russian outages that have been powerful for oil markets. And as a result, we're nudging towards 70 right now, right here in September. There'll still be a slowdown in demand. You've got to get around hurricanes. But at the moment, we're definitely higher than we otherwise anticipated. So that's, is what it is, and we'll see whether the economy holds up and whether Chinese keeps inventory buying, and et cetera, and as to where we go next over the coming 6 months into the seasonal demand slowdown. But I'm still sticking with my view that the low in oil will come in February 2026, If we're at 60 at that point, obviously it's going to be super bullish. If we're below 50, I'll say I was right. So let's see what happens next. All of these things, the Russian outages, the Chinese inventory build, are highly tenuous in terms of building a long-term case. And that sort of thing has been very negative for investors in oil equities, because you can't capitalize that stuff. You can't say that's a 20-year Chinese inventory build. It won't be. It's a 1-year, 2-year build. And so the market has continued to buy other things than oil, notably Nvidia and the AI bubble that's going on, where you're in a situation where now Nvidia is, they're all like you saw in the cable boom and the internet boom. Everyone starts buying everything because the capex cycle is so strong, and we think that will keep going, but it tends to leave oils underperforming. Now, having said that, we said there's been a couple of really important long-term structural shifts here that are coming from forecasting agencies that are actually very bullish for the equities, more so than they are short-term for the oil price. One of the first things was, for example, Exxon's annual energy outlook came in and said that they anticipate that oil demand will stay flat between here and 2050. Now, of course, other agencies such as the IEA and others have had very negative long-term outlooks for oil demand. We've always been more in the Exxon current camp, which is that there'll be a long plateau, and that's a function of price and demand and supply and price, which means that there'll be a long plateau in oil markets at this huge level, 105 million barrels a day currently. And as a result, you would see that flat long-term demand outlook. But the general view, which was really bottom ticked by BP in 2020, was that oil demand is peaking here. Chinese demand is peaking notably, and that will be very negative for demand outlooks. And as a result, the long-term demand outlook is to the downside. What you're seeing is just the sheer weight of global population and somewhat the failure of EVs and electric vehicles is changing people's forecasts to that long plateau view. And if you have a long plateau, you can then turn your attention to the supply side of oil and see how that's doing. Now, one thing is the US production side is holding up very strongly, and that's been a surprise. And again, that may be that if we go any higher, actually people start putting rigs back to work, which would be bearish. But the company that does that is going to be hated by the market. Broadly speaking, we expect US production to go into decline over the coming year on lower prices. But at 70, some people have got to be tempted to start drilling again. But anyway, the general view is that US production goes into decline, which is bullish. But more importantly, the US marginal supply has been almost all the growth in global oil supply over the past 15 years. And so when that goes into decline, you start to pay attention to where other supply can make up for the natural decline, which is very high rates of decline in US production. And then after a surge of non-OPEC production that we're seeing right now from places like Guyana and Brazil, you begin to think actually there's a limited number of places that can supply more oil. And most dramatically, the IEA came out last week, right when I was listening to Exxon talking about how oil demand would stay at a plateau. The IEA completely capitulated and suddenly started saying, actually, we have a decline rate problem in oil and we're not investing anything like enough. And their number was that you need 500 billion, I think was the number, of investment annually in oil supply in order to maintain production. And the current clip is about half that, 250 billion a year. Keeping in mind that right now AI is getting up towards 550 billion just from the identifiable mega companies spending. So AI spending continues apace, but oil spending is very low. And the point here is that there's now a structural bull argument that's emerging in the market. It's very early days, that the oil age is going to go on much longer. It's becoming accepted that the oil age will go on much longer than it was previously feared. For example, around 2020 was the low in terms of how it was all over for oil. And at the same time, people are beginning to get concerned about a supply problem. Additionally, basically at the beginning of summer, Saudi and OPEC said, yeah, you can produce as much oil as you want, because it became so confused with all the quotas and everything else that anybody who wanted to cheat would have cheated. And the supply response we saw was actually very, very muted, even from Saudi in terms of exports. And so that's making people think there's less spare capacity. And we've incessantly talked about spare capacity, but spare capacity now is getting down towards only 2 million in Saudi and 1 million in the UAE, and not a lot of stuff elsewhere. And as a result, you begin to think, oh my goodness, it's not that far off that we get to a point where we lose, let's say, 1 million of supply from the US. We continue to see 1 million of inventory build from China, and suddenly oil gets really exciting over the next 1 or 2 years in terms of the fact that it has to structurally reprice higher to encourage companies to start reinvesting in things like exploration. But all of that is long cycle, and the companies are going to be very nervous about announcing capex increases. The point is that you're now developing and it's percolating into the market. I think we've always had these arguments long term, but nobody was really listening or cared. But I think over the coming year, particularly if oil stays high here, people are going to increasingly start looking at that structural argument, and they'll begin to capitalize it in the oil stocks. So we're now really quite positive on companies with long inventory lives. One example, this afternoon on my call, we're going to have Eni. They've done very well in terms of exploration, where the industry is struggling. They've got a lot of 2P reserves. They're strong in Namibia. They have a very high free cash flow yield, 10% trailing, 17% forecast. And there are other examples. The Canadian oil guys will always tell you the Canadians have tons of inventory. You've got guys like Exxon and Chevron with plenty to come. And those with good yields and the market beginning to buy into the idea that the oil age lasts for another 20 years become highly investable stocks, almost regardless of how low the oil price goes. Now, I was just with a major client, and he was saying, like me, I really hope that oil gets low over the next 6 months, because that's going to be an awesome opportunity to buy in. The concern is that the way things are working out, as I've explained, the oil's not going down as much as we had hoped in order to get really bullish at the bottom. But it's still all about February 2026. And so what we'll do here is we'll tough it out with the bear call while saying that the oil stocks are looking quite attractive to us and will probably get more attractive to the market over the coming year, especially if we hit a low in oil. Okay, let's do some quick tourism. Yeah, there's the post office tower. That used to be the tallest building in London, but I think back there is the Shard. And then down that way is West London. And white here, that's what Paddington looks like. Alex, you got to have energy, man. Let's not forget that. Have a great week.